got into a lot of trouble there. So this is a good little put, but not little, but this is a good put butterfly movement on SPY as it's moving down. It's getting towards the profit range. Again, as I mentioned, if it starts to recover, you just have to look for a way to try to manage that so you don't get back into the loss on the upside. I'm not saying it is. I'm just saying that's the approach with this position. As Mark mentioned, he's all the way out to February and actually has another series out to March as well. And you say you got yours, Mark. This debit we were looking at here, the debit butterfly, you got in at 350. So I'm close here with those numbers with a debit of 345 cost into the position as well. Okay, and yeah, okay, so this goes sort of hand in hand. Sam says, well, Sam offers his comments and says it looks like a sort of a good trade, but you know, if there's recovery, if there's bouncing up and down, you have to be careful. Mark comments in, he says, I would exit when the center is reached. Well, you know, if it keeps going down, that's good. If it starts to recover, though, if it starts to move back up, if it starts to see a snap back up for whatever reason, what would drive it, Mark? I don't know. Again, I'm not saying that's what's going to happen, but you've got to start to be careful about that position going forward if it does start to move back up in that direction, because what's going to happen, you're going to start getting favorable here, but as you can see, you're going to start losing in this direction if it does start to recover back to 250, 251, 252. You've got a lot of time. Time value is still inherent on the short options and on the long options as well, even the out of the money 210 going forward. That's all the difference. What Sam was referring to is that he does ratio back spreads when he has a debit, little different play, or maybe he's just doing it in that fashion as well. What Sam typically does is has the opposite, maybe sort of a V pattern this way, so he tries to profit on the wild swings with the long going either direction. There's sort of a straddle or strangle long with selling outside wings to help lower the cost basis over time. And this can be adjusted well, as I mentioned, as we just have a bear put debit combined with a bull put credit to give you an all put condor in this case. And as Mark mentioned, yeah, he'll get near that center, of course. Here's the halfway point on 121, the expected profit here, 476 with the current implied volatility, if it's right there. So it's not going to reach that peak until February 15th expiration when the time value decays out. But here you'd still have a reasonable profit, or you could manage one side or the other in that case to try to increase the profits, convert it to maybe a condor, depending on the new range you think of expiration going forward. Okay. All right. All right. Okay, sorry folks. All right. So we're going to let me go down here real quick, okay? Yeah, and Sam says his straddles are based on earnings, but there's also directional plays he's doing as well. He bought Nike at 68 yesterday. That's interesting. Bought shares of Nike at 68 at that time. That's pretty interesting. I'll have to take a look at that in a moment too. So anyway, we're going to move on to JD's question now. Okay, sorry, while we're here. Yeah, that's what I was referring to. You know, let me go to this way to Sam one more time, comments. And Sam says, if SPYs goes lower next week to 200, then what? Well, that's what I was talking about, is that, you know, Mark was saying gets at the center, he's going to adjust it, whether it's here or whether it's here in that situation. And if it does exceed a deeper decline, this is another 40 points. Again, not saying that happened, but we always want to look at the worst case scenario in either direction. What if it rebounds to 260 from unexpected news that comes out? You know, what if it goes down to 200? Where would we be? Well, you can see the curve of the halfway point here. You don't want to necessarily get into a loss, so as soon as it starts to go back to these values, you'd have to manage the butterfly one direction or the other. Maybe move one of the spreads out to create more of a condor. Of course, that might lower the return at that time in either direction, but it's trying to keep you in the safety zone here. Of course, there's other ways that you could do it, convert it into a ratio spread without taking on extra risk, perhaps, depending on the structure and the direction that it moves as well. Okay. Oh, okay. Mark's comment here on this part of the trade is that if it falls rapidly, and let's say by the end of next week, probably too much, but let's say at the end of the next week it drops down continues down and goes to 220. Mark's opinion or sentiment there is that the implied volatility is going to increase. And you're right, but what would also happen is this one might actually decrease, believe it or not. All right, because it's gone from a deep out of the money to a closer to at the money. And as we see on any chain, the deep out of the money options and the deep in the money tend to have a higher implied volatility in most cases. Even on SPY, we saw that when we looked at the chain a moment ago. So as it shifts down, you might see the increase here on these options that are going deeper in the money. So let's say that this does go back to 0.322, and this goes back to about 0.3. And this might drop to about 0.6. So we might go to an average. I'll be nice and say 0.31. So if we drop down to 220 there, expectations are, of course, that the 2 calls would actually be at a loss here because now you're in the money, right? So it's 10 points in the money for those 2 calls plus the volatility out to February 15th. So you're going to be losing 840 on those. You'd be making a profit of 1100 here and 66 here. Even with an increase in implied volatility, let's put it up to 37 or 38, which is really high, probably unknown. You're still looking at a profit of about 120, maybe a little bit less or the same that you have right now, and that's on the 28th. Now, if we drop further, a massive spike down to 210, we're getting more countered by this middle range, getting up a higher delta, and we're seeing a good change on the lower strike now out to February 15th. My expectation would be a smaller profit, just as the graph shows. It's starting to unwind here, even with an increase in implied volatility. If we took this up to 0.45, we're still gaining well here, still gaining a little bit here, but this is really taking a hit because this premium is really getting extended. Now it's also 20 points in the money, plus time value, plus increased intrinsic value. And you've got 2 of those that you're short on compared to the 2 longs, where one's almost at a delta of 1. It's just a little bit above intrinsic value. And the other one's getting a spike, but not as much as those now slightly in the money double ones at the sell price. So even with an increase in implied volatility, the short options, if it breaches below that point, that's going to cost you more to buy back or more to adjust. And of course, you may only need to buy back 1. Personally, if the SPY dropped down to 210, I'm probably not touching this side, right? Regardless of what it is, unless I'm near the maximum profit of the 20 points back, which I won't be if there's that much implied volatility because there'll still be so much time value left. It might be at 17 or 16 until we get closer to February 15th expiration. It might even be lower than that. But then I'd manage this side, right? The side that's being threatened by the direction. The bear put's working well. The bull put's the one that's getting into trouble. Even with the heightened implied volatility, that one short put is kind of hurting me the most on the buyback cost, and I'm not seeing the gain here on the at the money or further out of the money as I am in the now in the money with an increased implied volatility on the position. In most cases with those types of butterflies, you really need to see a high shift in implied volatility, something that I don't think you'd see on SPY. I mean something moving from 0.45 to about 0.75. I think this is way too much. I don't know if we'll see the implied volatilities, even on those options further out in time on SPY, as high as 45%. And we might, but I don't think they're going to reach that level quite yet. But we'll see. Okay, and he also mentions there he would look to manage the whole butterfly or close the whole butterfly, of course, in that situation. So he gets the profit target he was looking for. He's not expecting the full profit as we discussed. He's not expecting it to end right at 2:30 on February expiration as well. Okay, let's talk about a married put trade now. There we go. All right. A good married put trade. I'll say something I considered doing, but during the webinars this week, I promised everyone I was opening a new married put based on the search results, and I did. And it's not going in my direction, but that's okay. I'll be able to manage it and still lower the risk. But for JD, what he did is he did a married put on SH. Fantastic. 3077. SH, of course, is the inverse SPY ETF. So we did 3307, or 3077. My apologies. And then you purchased May 33 for 230. Okay. So a married put position looks like it's done perfectly in a bearish market because the stock's up to 32.72 while the rest of the market's falling. Now, he added it to the portfolio and he looked at the position analysis. Let me just see if I can get the same one. So I'm going to click Add to Portfolio. Let me just plop this into the December 14th one. And we're going to buy 100 shares of SH. Date doesn't matter, but I'll take it back to the 13th. Okay, so buying shares of SH at 30.77. Buying the May 33 put for 230. Looks pretty cheap, actually. Maybe you legged into it, but that's okay. Right now, SH is up 6.3%, and with the implied volatility increase, that's what's really helping you. You say you got in at 230, okay, and so it's right at about intrinsic value or so, so maybe you legged into it. In any case, here we are. Here we've got a $1.95 gain on the stock, only about a 15-cent loss on the put, so you could liquidate right now for a 5.4% gain on this position. Oops, sorry, folks. But what he's mentioning is he sees an idea for bulletproofing in the position analysis view where it shows JD that he could roll in time to, you pretty much got low risk on this position anyway because of those prices. Let's see, there we go. So you could bulletproof it with a collar, which would cap the direction, or you could do it with income method number 3 and then still sell a call. What in the world? That is interesting. The January 33 put. You said you saw a February put. Okay, let's see. Bulletproof. Yeah, you can bulletproof with a February 33 call. So I can get a bulletproof here by selling, you're right, the February 33 call for 105, cancels the risk, bulletproof at 3.1%. Is this a good idea? Well, it's always good to cancel all of the risk, but the new chart is the one in blue. This is what your structure would be. So you could make a profit here, a max return, about 8%. $256. If the stock is trading right at 33, the ETF is trading right at 33 on February 15th. We're going to see some swings between now and then, up and down in your case, in everyone's case. We're probably going to see some swings up and down for that as well. Okay? However, it's a good 8% profit, but if you're expecting more of a move in this direction, that the market's going to continue down, which means SH will continue up, or if you think it's going to recover backwards, this is pretty good because you've got a bulletproof position down here or up here, small profit. But unfortunately, what we're looking at now is this puts you at a peak position, meaning that you could make 8%. You have a bulletproof trade, guaranteed profit of 2.4% or $78 with this transaction, either direction. I can't fault that at all. That's fantastic. But that 8% gain over the 5.4% if you liquidated right now is just here. We did see another opportunity to bulletproof the trade as well. And this one is interesting. This one's actually forcing the put to go, oh, no, it's saying you could roll it in 1 month. I'm sorry, I read that wrong. I thought it was 2020. you could roll into the January 33 put to generate some credit. Sell to close your put right now for, for about $1.95, so you'd lose 40 cents, and buy a closer in for $1.35, so you get a 53-cent net credit, essentially, which bulletproofs the trade, and you've got a 1.6% guaranteed profit with unlimited upside, but now only through the 18th of January. Okay, so here's that side-by-side comparison again. It looks a little bit different, but now with the bulletproof status here on the new position that expires in 28 days or so, 25 days, instead of going out to February with a short call. What's the difference? Here you have a guaranteed profit of 1.6% to the downside with still unlimited upside and potential to make more adjustments. The market continues down and SH continues up. Where, as with, I apologize, with selling the call now, the February 33 call or the January 33 to bulletproof the trade by generating the premium, you get a max return of 8, still good, and you bulletproof to 2.4% in either direction. Okay, so that's your trade-off. If we try to look at the two income methods, one on top of the other, which I can't do there. I changed my pen color. Here we go. So let's take off where we are right now and take off this. Here's if you sold the February 33 call. Peak profit, guaranteed 2.4% or $78, any direction it moves from here, up or down, no less than 2.8% profit, potentially profit of as much as 8% in the wild scenario that between now and February 15th, it goes up, comes down, comes up, comes down, right near expiration, it's right at 33. Or we saw you could roll into January and bulletproof the position by rolling into the January 33 and having a 1.6% guaranteed return. If the market recovers and SH starts to fall, you'll still be able to sell a call or do something in that way to maybe increase that 1.6% guaranteed profit, but you still have more upside in this direction. If the market continues to fall, SH will continue to rise, and this, of course, still is a 2.4% gain up here. So what is your target for SH going forward? 28, 29, 30, up to 31, 35, 36, maybe in that range, then this would probably be a better adjustment. Anything I'd say beyond 37 or 38, if you think SH might go that high, I'd be more tempted to roll in to that January put to bulletproof, and then you could reevaluate SH as we get closer to January. But the two graphs there share what it is for the SIGA model that we're talking about. You know the conditions of your positions. Now we're talking about the expectations, and one could never know. So the question is, JD, are you more comfortable with this? 2.4% in either direction and a potential 8% return if the stock's rate at 33, and essentially between this mark, almost a 10-point mark from 28 to 38, you're probably still making above 2.4 up to 8% return. Now that looks pretty good to me. I can't fault this trade. But if you think the market is going to continue the bloodletting, for lack of a better term, if we want to use cliches here, you think it's going to continue to drop. Sam threw out that number. What if it drops to 210 or to 200? That means that SH might go as high as 38, 39, 40. In that case, if that was my expectation, I'd be tempted to do the January roll in, even though I'm shortening the time to only 30 days, but leaving the upside open, and then you could still sell a call against that later as it continues to move up. Okay, so that's another thing to consider. Sam throws out that he's using the SQQQ, SRTY, and VXX, and he's up about 30% there on those since September. Yeah, UVXY has been good. It's at a higher cost, and I use the I apologize. I actually use the VIX, as you know. Okay. All right. Good, good. Okay, so that's what comes down to the Siegel model. Either one is a pretty good trade, okay? Depending on what your goals are for the position, remember we'd be selling the February 33 call here, or we'd be moving it closer in. So either one is a good profit and loss chart. It's good protected position, guaranteed profit, and you could still maybe adjust this short call if you wanted to, because we still have the put out to May in this example. And the other example I'm talking about, we only have to January. Yes, you could get some premium by selling a call if you move into the January 33rd in that situation. So either one is good. Either one gets you to a no-risk position. It's just a matter of question of what are your, now that we've talked about what are your expectations, which would help you decide between this and a lower guaranteed profit to the downside but still limited upside, then what are your goals? And the combination of expectation and goals would help you determine which one of these two adjustments work best. Moving into January, shortening the time drastically, but still being able to go for the next 3 weeks of potentially a chaotic market with no risk and unlimited upside, or selling the call here to bulletproof at 2.4% in that scenario, and the potential to 8% return, but that's out to February, 60 days away roughly, or 56, I think we saw. Okay. All right. Yeah, and Sam, this is something that I noticed. I did this twice, meaning that I have done married puts on SH twice in Fusion, in the Fusion subscriptions. And one thing that I've tended to notice, let's just take a look here. Sam points this out, and it's kind of tough to do, but this is a good movement. But think about it this way. In the last, we've seen the chaos in the last couple months, but starting in December, we've seen about a 4.5-point move. Actually, really just about a 4-point move from about 28.50 to 32.72. All right, that's not bad. That is more than 10%. Okay, but it was very quick. It's very profitable because of what's happening in the market. But it's about a 15-16% gain, maybe a little bit more. Okay, but at the same time, from December 1st here, and we are down at the low, we look at SPY, we dropped from 280 to 240. Okay, so we dropped 40 points on 280. Same percentage movement, but what Sam noticed and what I noticed is that in general, the standard inverse ETFs tend to move more slowly. This was probably the best time to be in one of those. Absolutely, either as a market hedge, as a married put, maybe even as a covered call. This was the best time to be in one of the inverse ETF positions. I can't argue that, and I won't argue that. However, they tend to move more slowly. What I've also noticed about these positions, the contra ETF, inverse ETFs, is that they move up very slowly. I mean, this looks rapid, but think about the market that we've had. It has shown a good 1-month return, as I mentioned, about 14-15% or so. I'm sorry, yeah, 13-14%. Now, the other issue is that when things start to settle and SPY comes back, it'll tend to recover and regress, I should say, to the norm faster. It's kind of interesting in that scenario. I think I held SH when I did as a married put the first time, and I got a 1% return over a 3-month period because I didn't see the drop I wanted. And the next time I did see the drop I wanted, I made about a 4% return in a 2-month period. But it was just a little bit better than I was doing in a bullish market. It wasn't even better. It was about average to what I do in a bullish market, so it wasn't really giving me an advantage. So what's the idea? Well, there's a 2 times inverse ETF for SPY. There's a 2 times and a 3 times inverse ETF for QQQ and the NASDAQ as well. The problem is they move more quickly, so there's more volatility. So protecting a stock position or buying just a call to take advantage of the movement is really expensive. Yes, you still see a good return, but again, it's because the volatility is so high, sometimes it's difficult in those situations. But with a 14-15% gain, which might have equated to a 23-24% gain on the 2 times, you still would have had a really good profit. Well, let's check it out, shall we? Let's take a look here. I'm just curious now. Oh, there we go. Sorry. I'm just going to pull something up here. I don't know if I want to. I just want to do a 2x. I'm sorry. I'm just looking for the one. I'm trying to figure out which one I want to look at. Okay. There's SDAO, SDS, I think. Oh, no, that's the ultra short. Yeah, it's the ultra short, SDS. I think that's one of the ones you mentioned, Sam. Let's look for one of those there's a 3 times the crude, 3x, 2x. All right, let's just look at SDS from December 1st on. So let's just look at the quotes here, okay? All right, so I'm just going to take a look at the quotes here on SDS. 46.89 is the ultra short S&P 500. So we're at 46.89 now. On December 3rd, we're at 35.47. Okay. So yeah, 35 there to 46, where on SH, we've seen them 4-point move from 28 to 32. So 12-point move versus 4-point move. It's kind of significant there. Is it 38? Yeah, I'm sorry, 35, almost 36. So about 10-point move versus a 4-point move in that case. So it's still looking pretty good there. And Sam says that's the reason we look at the 2 and 3 times. But you can see there from the example, and I'm not trying to say one's better than the other, but you saw during this last time you saw the 4-point movement on SH and of course SDS there, the ultra short. We saw the 10-point movement over the same time frame from about 36 up to about 47, so almost an 11-point move. Harder to protect, though, because the puts would have reflected that. Harder to buy options on this 11-point move because the calls would have reflected that. Let's go ahead and see what the calls were worth for January expiration. Not necessarily today. They would have been profitable. But on December 3rd, excuse me, on December 3rd, let's just go 4th of Jan in that case. So yeah, the volatility is not, oh wow, it's actually not too bad. It was pretty depressed at that point. So yeah, we could have bought a 35 call for 133, 135. And then today, 133, 135. Sorry there. There we go. And we need the medium chain now. Yeah, it's at 9.7. Wow, look at that bid ask. It's at midpoints around 1190. Black-Scholes around 1190. The implied volatility, of course, is these ones here around 0.4, 0.6, 0.5. So they've jumped up from 0.3 to 0.5, even 0.6 in some of the at-the-money options as well. Yeah, too wide and hard to fill. I just noticed that. Yeah, look at this here. I couldn't buy these now. 20 to 435, 20 to 395, 150 to 380 is not bad. Yeah, 220 to 6. Yeah, that's the problem. Volatility, wide bid-ask spreads. Fill prices are very difficult to get into with the 2 times and 3. This is even a 2 times, not the 3 times. You run into that problem after we've seen sort of the market move that we've had to get into those positions as well. And then, oh yeah, opposite, it's going to be just as hard to sell, sure. So it's hard to get in to buy. Now it makes it difficult to sell because you're not going to get near the ask price. Hopefully you can get near the mid, but you're going to be challenged on that to get the midpoint price. What looks like a good return, you might not get it. Okay. All right. Oh, okay. So there's that on that. I was just thinking about, just want to take a look at this real quick. Sam referring to his Nike position here and got into shares of stock. I don't know where you originally were. I'll just go to January for, let's say, 3, but you bought 100 shares. Oh, sorry, folks. at 68, you said, and at the same time you bought the 70 put, and I'll just put in a value of 3. All right. Oh, sorry. How about that? 168. 1 at 3. Doesn't matter the exact prices, but you said as the stock was moving up, moved up 4 points here to 72.37, naturally your put lost about half its value. So you sold to close that. It's right at around 170 now, I think is what I saw. Is that correct? Standard January. Yeah, 170. So let's say you got 154. You lost half, but you've gained 4 on the stock. So let's take that off the table and reduce our cost by 150. Put it down to 66.50 in this case. And then you said you entered a bull put spread on it. Now, one thing I don't advocate, and it all depends on the customer's account size and what your goals are. So let's say I sold a 70 put then at that point and maybe bought a, let's keep it at 250. 50-cent credit on 250 looks pretty good. 70, 67, 50. Bull put on the stock where you lowered the cost. Okay. So you get about a 60-cent net credit here, pretty high. So it gives you unlimited upside. The thing I don't like about this approach, though, was, 71.70. Okay, so you only did a 1-point spread, so it's probably closer. Sold the 71, good, bought the 70. So your margin is much smaller, but again, the situation I have here is that put that you bought can cover one or the other. You know that, I know. So we're in a bull put here with just a long stock. So we still have that loss at 68.40, of course, because as the stock falls, the long put can either only cover the short put or the stock itself. You only have to put up the margin of 250 to cover the bull put spread. That's not covered by the stock ownership. So it does increase the risk, but again, of course, we could always add in the extra put later on as it continues to fall, or just liquidate one leg, maybe buy to close the short put and roll that down, and maybe with a bear put debit spread in a stock in that case. So yeah, you're still taking on a reasonable risk, but it's the cost basis of the stock now minus the net credit plus, in your case, a 1-point spread, in my example, a 250 spread. So you still have that infinite loss. It's not going to go to zero, I know, but at a large decline, if something did snap and it dropped back to 58 or 55, you lose the 250 on the bull put naturally, and you're still losing on the stock because it's not covered by the long put. That's covering the short put of that spread position. But then we'd manage it other ways, of course, just as we would with a stock that had fallen in price initially. Exit it, close it out. But that's really good. And let's take a look here. If, when you got in at 68, you said, and yeah, had its nice little pop-up today, I guess it looks like. And it's pulled back, had the nice pop-up today. Oops, sorry, where am I at? There we go. Yeah, it was due to the earnings pop. So that was a good earnings play, changing the direction on it after you were losing money on the put there. Convert it to a bull put thinking it's still going to go up. But as you mentioned, we were going to have to we're going to require, the market to continue up. This might get draw back down. But very good play. I didn't even see Nike come up in my search for earnings plays this week. Might have popped up later in that scenario. And then when I searched, I believe I searched on Monday as well. There's that extremely bullish buy. Now, let me be clear on this. The market sentiment. Let me just make sure we're here, still here at 10 and 3. Just probably updated in the last 10 minutes. Yep, we're at 10 and 3. Extremely bullish buy on the market indicator. What does that mean? A question asked me this, and a customer, asked me this earlier today and said, hey, I'm seeing a bullish buy on the sentiment tool. Is it broken because we're in a severe bear market? Well, the market indicator tool, the market sentiment tool, is based on 13 broad-based indicators that Ernie used and tracked historically over 7-year period, 13-year period, and sort of calculated them all together, meaning that he looked for the fences. For example, the put-call volume ratio. Well, as we all know with the different ratios, let me slide this over here so we can see. This went bullish today. When you click on the details, you can see the histogram plot of the distribution over, as I mentioned, the last 7 to 8, maybe even 10 years now. I forget how long it actually is. I'll check that with Ernie on Monday. But the fences are set to when you see these ratios get to a certain range. So the histogram here shows us that, you know, in here we're bouncing around. It's more neutral. It's going up, it's going down. When we get down here and we get to a put-call vol ratio on this side of, let's say, 0.43, meaning there's much more puts than calls, about twice as many puts than calls, you very rarely see it go further than that, and that's usually an indicator that the market's going to go bullish. In this case here, the put-call ratio is up at about, oh, there it is. It's bullish when it's above 0.99. It's at 1.02. And at last market low, 2/11/2016, going back 2/11/2016, it was at 0.87. Okay, so historically, yes, it can go further than that, but we rarely see it move above this 1.02 range. Okay, over time. Now it could, but it'll still stay, it'll start creeping more to the bullish range. You know, the number of days the SPX is down, usually only see it down 3-4 days in a row, and then it'll trigger into the bearish. So I'm just showing you this is how we sent the fences for these 13 broad-based indicators. So typically in a market, in market conditions where you see the put-call volume ratio go above 1, when you see the SPX number of days be down 3 to 4 days in a row, we're at -3 right now. Gap over the SMA 20 is at -0.86. -8.6, I'm sorry folks, -8.6. It's almost a new level. So this is the percentage gap where SPY is below the 20-day moving average. You can see it's very rarely hit. There's been a couple other marks down here in the lower ranges. The other indicators, the number of stocks of the SMA 20, what is it, 0? 4%. Only 4% of all optionable stocks are above their SMA 20. I think this does specifically remove what we talk about with the, wow, thanks Mark. Mark says the put-call ratios were as high as 1.7 today. Whew. All right, so again, in this case though, I think this is removing the inverse ETF. So it's just talking about the standard stocks. Only 4% of standard stocks are above their SMA 20. Nike might be one of those 4% with that move it had today. High-low, 52-week high-low comparison. VIX, of course, we know when it gets above that 25, 28 range, it's usually a bullish indicator. It's going to settle. Now, for those of you who follow the 10-day trend, that hasn't gone bullish yet. All right, that's still in sort of a neutral mode, as is the number of days above the SMA 20. All right, so we're at -12 days, and it's bullish when it's at -12. So it's right there on that line. It hasn't pushed into the full one where we'd see almost 11 bearish indicators. All right, so these are all the ones, now that the market's been depressed, it's putting pressure on all of these indicators where normally they don't stay beyond these levels. And essentially when you see a trigger where we have 8 or so bullish and no bearish and a remaining number of neutral, that puts you in the very bullish buy. 10 to 3 goes extremely bullish buy. Okay, now, why am I going through all this? Well, it's to give you a better understanding of it, but also there's one thing that this tool cannot do. The one thing this tool cannot do is depict or reach out and say, what is the current news going on in the market? What is the next thing that could affect the economy, rate hikes, anything along those lines, a black swan event, a missile attack? It can't see any of those things, and I'm hoping we're not going to see anything that pushes it drastically down in the next 3 to 4 days going into next week, where we're only, it's going to be rough Monday, isn't it, folks? Yeah. Oh, Sam says government shutdown. Right. This tool can't look at that. Can look at historically what has happened with the indicators and why. Monday is going to be hectic not only because of how we're going to see the market plays out after this weekend. Remember, it's a half day. And then we have off on Tuesday. The market's closed on Tuesday. So it's going to be a chaotic Monday regardless. It'll be interesting to see what happens Wednesday. So I may be managing down my married puts and trying to get as low risk as possible Tuesday, honestly, before the market closes, just in anticipation. I could be dead wrong. Market could spike back up on Wednesday after the holiday. We'll just have to wait and see. But again, it's, yeah, traders on holiday, light volume, but are still going to react to the news over the weekend, you know, and the fear with the other negative news. You're right, Sam. Absolutely. So there is always a lighter thing. I can tell because as the market's falling today, I only had 6 phone calls instead of 16 while I was working on my webinars and other blogs, where every day this week I've probably had about 16 to 20 different phone calls. Today I only had 6. I know a lot of people have already have already started traveling, left if they're traveling, and so forth. And you can tell by our attendance today. I know all of you online. I have talked to everyone here online at least 4 or 5 times, I'd say. Bhupinder by email a couple times, Harry, phone and email, Kent, phone and email, Kokan, Mark, phone and email conversations as well, email, Rajiv, Sam, of course, Troy, I think I've talked to you via email. I don't think I've talked to you on the phone recently that I can recall. And Valan, a couple years ago, we had a lot of conversations. One person here I don't know. I haven't talked to before. Anyway, all I'm saying is that there's 10 or 11 attendees now. Usually we're at 30 to 35 or 40 attendees on a Friday session. So it's lower down a lot because everyone's traveling. Yeah. All right, so we're going to be busy, but I wanted to mention this is that this is the market sentiment. It does work really well, and I hate to say it this way. It works really well for me on managing my positions in normal market situations. I don't consider this a normal market situation because 2 separate things set the market off this week, and then it was set off further by comments that were related and not related to the 2 or 3 things that were happening this week to affect the economy and the market. So it was really not a normal market condition where any new headline that came out could cause bigger fears and bigger fluctuations. So this is the pressure on the bottom. The indicators are saying they've been pressured to the bottom, and usually they'd be triggered to move the other direction. That could all change with any kind of new headline coming out over the weekend, in the next 5 hours, or Monday morning, unfortunately, and that's what this tool does do. Yes, Sam, I did like your nugget and your dust trade. I just didn't get a chance to respond to you about those earlier this week. I think you sent them on Wednesday, if I'm not mistaken, or Tuesday. I believe it was Tuesday when I saw those in the email, I believe, and I didn't get to check them as well. All right. Oh, okay, and you're still holding the Starbucks position. Yeah, I'm still in Starbucks. I moved it on Thursday to sort of cut the risk down a little bit, but drastically lower my cost basis. So it still fell, and I still have a loss similar to what I had I done nothing. But again, in that scenario, it's probably a different adjustment needs to be done on both that and the new position I opened on NRG earlier this week. Not doing too bad on either. I think I'm only down 2 or 3%, and both are down about 8% from the stock purchase price. Mark says the put-call ratios have been crazy today and yesterday. I haven't been paying attention, but I bet you there's a lot of profit taking back and forth with those, Mark. You know, you get a large volume blocks of puts on different scenarios and on different securities, and then profit taking was done, and they closed them out and moved them. And so you're seeing the volume move faster. But then again, that's why we track the volume, because the open interest usually doesn't update till the end of the day. We'd rather see it more in real time of how the movements are going. And you were mentioning the volume too. So we saw a lot of different movements today, I guess, in that scenario. Okay, but that's how the sentiment works. And normally, if I saw an extremely bullish buy, what would I do to my positions? Well, if I haven't already managed them, I wouldn't touch my married puts. Okay, if I had a married put, a covered call, or a collar open, and I saw this come up, I may be tempted to move that short call out of the way. Even just as simple as buy to close it. Get it off the table to leave more upside. If I have bear call spreads open, normal market conditions, and I saw this come up, I'm tempted to buy to close the short call and leave the long open. before, when I could, before the market would have closed. But of course, this updates later, so on Monday we'll have to see what happens in that scenario as well. Okay. Oh yeah, you did it before the meeting. Yeah, the FOMC meeting there on Dust and Nugget. Yeah, the dollar spiked and Nugget was taken down. Dust, you got out at 28 and bought at 24. Good, good, good. Okay, I didn't see the close. I didn't remember the closing prices for each one. Okay, and Mark throws in that extra view there that the put call ratio is very high at the first hour. That's when it hit the 1.7 and it came down to 1.4 by 10:30. Yeah, that makes a lot of sense, seeing what happened at the open and then what happened shortly after that as well. People planning for the event, right? The worst case scenario in that case, but a lot of money, what you're saying, a lot of money was being thrown into those puts and then maybe have taken off after the first hour or two going in. All right, well, ladies and gentlemen, it is 5:32 p.m. Eastern Time. I do not see any other questions or comments that come in relation to what we were talking about here today, covering some of the ideas. We looked at the butterflies, management of the butterflies. We talked about the market sentiment tool there, and we talked a little bit about the straddles, management of those positions going forward. I do want to remind everyone, of course, that today's material are just my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions. The options do involve risk, may not be suitable for all investors. It'll be interesting to see what implied volatility does. And of course, remember, a special end of the year bonus for the blueprint ends on December 31st. So you can pick that up, go to radioactivetrading.com and click on the products tab. You can take advantage of those 7 bonuses there as well. And at any time, you can also just take a 14-day free trial to PowerOptions. Just go to powerop.com, put in your name and email address. You'll have access for 14 days for free. Subscription services start at about $40 for end-of-day data and only $60 for the 20-minute delayed service as well. You want to check out some other educational information. Haven't put up anything new yet, but you'll start to see some new things coming out on the blog in the next week or so. And of course, you can always check out our webinars page for the archived webinars as well. We'll be back next week, as I mentioned, with some other articles I'll email you about, some other conversation, in addition to some other webinars after the holiday break as we go forward. You think of any questions later on, just go ahead and send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also call us during market hours at 302-992-7971. Yeah, okay, Sam throws in an extra comment there. He just wants to say, follow the market pattern in the open. Spikes up, and then after 10 or 10:30 it drops. Yep. Continues all day. This was happening most of the week. Yeah, it's that extra pressure, maybe those buy orders pushing things up, and then the market just says, yeah, we'll let you get filled on those, and then we're just going to go the opposite direction. We're gonna continue the pattern that we were on. Yeah, so your overnight calls and SPY profitable every morning, got out of them before the trade-off and before the switchover. Fantastic. Well, ladies and gentlemen, have a fantastic weekend. I hope everyone has a non-stressful Monday, Christmas Eve, of course, and I hope everyone has a Merry Christmas and a happy holiday break. I'll be around Monday if you need me for any calls, emails, or anything like that, and also be around Wednesday as well. So everyone take care. We'll see you soon. Have a great weekend. Good night.